All right, let's jump right into this explainer. Today, we're putting an absolute industrial giant through the ultimate financial stress test. We're going to take the raw data from a massive manufacturing powerhouse and run it straight through the gauntlet, the time-tested investing frameworks of legends like Warren Buffett, Peter Lynch, and Benjamin Graham. Plus, we'll hit it with some heavy-duty quantitative models for good measure.
So, here's our game plan. We'll start with a company snapshot, then move through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll crunch the numbers with our DCF and quant models, and finally wrap it all up with our synthesis and verdict.
Starting with Section 1, our company's snapshot. Let's meet the subject of today's financial investigation, Illinois Tool Works, or as you probably know it by its ticker, ITW.
Just to set the stage here, ITW is a highly decentralized, truly entrepreneurial manufacturing powerhouse. We're talking about a company that pulled in a massive $16 billion in revenue in 2025. They operate across 7 distinct industry-leading segments, and they lean heavily on what they called their do-what-we-say execution model. That culture of disciplined execution, that's going to be absolutely crucial for our qualitative analysis later on.
Now let's talk about the stakes. As of our July 2026 data, ITW is trading at $268.81 a share. The market clearly sees this as a premium company, no doubt about it. So our job today is to figure out, is it trading at a premium that's just way too hot to touch? Or do the underlying fundamentals actually justify paying up for that entry ticket?
You really have to look at their massive diversification. In just the first quarter of 2026 alone, ITW raked in $4.02 billion, and that capital is spread beautifully across everything from automotive OEM and food equipment to welding and construction products. It's like a giant, heavily diversified puzzle. That kind of wide-reaching footprint is exactly what gives a heavy industrial player its stability when the macroeconomic waters start getting a little choppy.
Moving right along to Section 2, the Buffett lens. Let's see how ITW holds up under a framework that absolutely loves quality, predictability, and a massive economic moat.
When we run ITW through Buffett's core checklist, I've got to say, it looks remarkably strong. Economic moat? Check. Their highly specialized, decentralized structure across 7 diverse industries really shields them from single-sector downturns. Consistent earnings? Absolutely. They just posted a solid 12% GAAP earnings per share bump to $2.66 in Q1 of 2026. Now, they do carry about $9.14 billion in debt, which sounds like a lot, but with their incredible cash generation engine, they can handle that load without breaking a sweat.
But here is the real kicker for Buffett, return on invested capital, or ROIC. It's basically the ultimate test of how efficiently a business compounds wealth. ITW boasts a massive 27.1% after-tax return on average invested capital for Q1 2026. Honestly, for a heavy industrial company to generate that kind of return on deployed capital, that is just exceptional. It speaks volumes about their insane pricing power and strict margin control. Buffett also loves what he calls owner earnings, right? Well, we usually approximate that using free cash flow. In Q1, ITW converted an impressive 69% of its $768 million net income directly into $528 million of pure free cash flow. If we annualize that out, we're talking about roughly $2.1 billion in cash generated for the year. Buffett would definitely admire the sheer quality of this business, though, spoiler alert, he might demand a slightly steeper margin of safety on the current share price before backing up the truck. All right, so Buffett might be intrigued. Let's move to Section 3, the Lynch lens, and see how the stock fares when we hunt for growth at a fair price. Peter Lynch would undoubtedly toss ITW straight into the stalwart bucket. They aren't some high-flying, speculative tech startup. They're a mature, lumbering giant, but they are a hyper-reliable one. In their Q1 release, management confidently bumped their full-year 2026 EPS guidance by 10 cents to a midpoint of $11.30 per share. Stalwarts are great because they offer solid protection during recessions, but, and this is a big but, you absolutely have to buy them at the right multiple. Now, the absolute crucial metric here is the PEG ratio. Lynch popularized this to compare a stock's price-to-earnings ratio directly against its growth rate. So, taking ITW's price of $268.81 against that expected EPS of $11.30, the PE sits at a pretty hefty 23.78. Meanwhile, their current earnings growth rate, that's hovering right around 12%. So do the quick math with me. Dividing a PE of roughly 24 by a growth rate of 12 gives us a PE ratio of right around 1.98. Lynch strongly prefers the PEG of 1.0 or lower, which basically tells you you're paying a fair price for the growth you're getting.
Their balance sheet is rock solid with $6.33 billion in current assets, easily covering $5.33 billion in current liabilities. Now, our data sources don't detail insider or institutional ownership, so we kind of have to assume a neutral stance there. But honestly, because of that high PE ratio alone, Lynch would almost certainly slap a hold rating on ITW at current prices.
Now for Section 4, the Graham Lens. Let's look through the absolute strictest lens of all, championed by the godfather of value investing himself, Benjamin Graham.
Running ITW through Graham's strict defensive investor checklist gives us a bit of a mixed bag. The company breezes through the tests for adequate size and earnings stability. It also flaunts a fantastic dividend record, recently declaring $1.61 per share for the quarter. But then, it hits a brick wall on the valuation checks. Graham wanted PE ratios under 15 and price-to-book ratios under 1.5. Brace yourself, ITW is currently trading at nearly 24 times its book value. No way Graham lets that slide.
To really grasp how Graham would view this massive valuation gap, let's actually crunch the numbers on his famous intrinsic value formula. We need to see exactly what he'd consider a fair price for a piece of this business.
Okay, we take his constant of 22.5, multiplied by our full-year EPS estimate of $11.30, and then multiply that by the book value per share. Based on their Q1 balance sheet, total stockholders' equity is $3.23 billion, spread that across roughly 289 million shares, and we get a book value per share of just $11.17. When you run all that through Graham's square root formula, it spits out a rock-bottom intrinsic value of just $53.29. I mean, wow! Graham demands a massive margin of safety and a ton of tangible assets, so it's really no shock that a modern, capital-light stalwart like ITW fails his test spectacularly. With the current price sitting way up near $268, he wouldn't touch this with a 10-foot pole right now.
Okay, so Graham heavily discounted the stock based purely on historic book value. Let's fast forward to Section 5, DCF and quant models, and see if modern math paints a different picture.
Since our source data gives us Q1 financials, we're going to build our baseline discounted cash flow model using that annualized free cash flow of about $2.1 billion. Now, for an established industrial giant like ITW, we'll assume a standard 9% weighted average cost of capital, or WACC, as our discount rate, and we'll bake in a conservative 2% terminal growth rate into perpetuity.
When we lay these numbers out across a sensitivity table, we get a nice range of fear values based on how those assumptions might flex. At our base case of a 9% discount rate and 2% terminal growth, the fair value lands right around $166.70. And get this, even under the absolute most optimistic assumptions on this table, an 8% discount rate and 2.5% growth, the DCF model only crawls up to a fair value of $214.30. The pure cash flows just mathematically struggle to justify that current $268 price tag.
But hey, just to make sure we aren't missing the bigger picture, we ran two other models. Since ITW pays a really strong $6.44 annualized dividend, we applied a dividend discount model assuming an 8% cost of equity and a 5% dividend growth rate. That model pops out a fair value of $214.66. Alternatively, if we look at comparable companies and assign a pretty generous 15 times EV to EBITDA multiple, we get an estimated share price of roughly $175. Literally, every quantitative angle we look at suggests this stock is currently priced for absolute perfection.
All right, we've gathered all the evidence, from the legendary gurus all the way down to the cold, hard mathematical models. Let's bring it home with Section 6, Synthesis and Verdict, and give you the final takeaway.
So here is the absolute crucial point you need to understand. ITW is a phenomenal, incredibly profitable business. Their return on invested capital is outstanding, their ability to convert net income straight into free cash flow is robust, and their diversified model gives them a seriously enduring economic moat. But when we summarize our models, all the way from Graham's ultra-conservative $53 up to our most generous dividend model topping out around $214, it is crystal clear that the market is demanding a massive premium for that quality. The risks aren't in how the business executes, the risks lie entirely in those sky-high PE and price-to-book valuation multiples.
With the stock sitting up at $268, our final synthesis points to a very clear verdict. ITW is a hold. Honestly, all our gurus, from Buffett to Graham to Lynch, would likely just be waiting on the sidelines right now. The underlying business is stellar, for sure, but the current price offers zero margin of safety. So the real question this explainer leaves you with is this. If the absolute highest quantitative models top out around $214, at what price would this high-quality stalwart actually trigger a buy in your own portfolio? Keep this one on your watch list, and maybe just wait for the market to give you a slightly better pitch to swing at.